Is U.S. inflation running hot or is it actually cooling off? That would depend on which headline that you read and which numbers you focus in on. Core inflation in the U.S. just had its biggest jump in 6 months, 3.1% up year over year, and that's up from 2.9% in June. Now, the market reaction here was interesting. Before the report, there was an 85.9% chance of a September rate cut. You can see that here. Afterward, though, that jumped to 94.2%. That's according to the CME FedWatch tool. This morning, that's up to 99.9%. Now, when you look at that at first glance, it makes zero sense. You'd think that higher inflation would make the Fed less likely to cut rates. But here's what's really going on. The markets weren't reacting this time to the level of inflation directly. They were more reacting to that gap between their fears and reality. They were bracing, in essence, for a blowout core CPI number, maybe 3.2%, even 3.3%, thanks to the new tariffs, thanks to the sticky services inflation that we've been seeing. So when that came in at only 3.1%, still high, but it's not worse than feared. And so traders saw that as a green light for the Fed to stick with its plan to cut rates. Then you add on to that the most recent awful jobs report that has been talked about so much. We have softer headline inflation. We'll talk about that in just a second here. Political pressure from Trump, that's continuing. So suddenly the risk has shifted, and keeping rates high now kind of looks more dangerous for the economy than actually cutting them and risking a little bit more inflation. And that's why the odds for a September cut didn't hold. They jumped to that 99.9% that I just talked about. Now, a couple of key numbers we have to focus on here. First of all, the core CPI, and that came in at 3.1%. That was above the consensus, which was 3%. Also, that is the fastest monthly increase, plus 0.3% since January. So that doesn't look like things are going in the right direction. But then you look at the headline inflation, that is still at 2.7%. That's the same as June, came in below the 2.8% consensus. Monthly CPI, that was up 0.2%. That is cooler than June's 0.3%. So with this latest report, no surprise here, President Trump, he wasted no time in calling out Fed Chair Powell. He said on social media that Powell must cut rates now because high rates are hurting the economy. He posted, Jerome, too late, Powell must now lower the rate. Now, somewhat ironically, I would say he also then added, fortunately, the economy is so good, etc., here. So those are kind of at odds with each other. Now, Powell, we have to remember here, he has a dual mandate to maximize employment and to keep stable prices, right? Until recently, he's argued that the labor market is solid, although inflation risks do remain. So that's why they've been holding rates steady. But here's the complication. The latest jobs report was, like I say, horrible. Headline inflation did not accelerate this time. So we look at those two in combo there, that kind of leaves Powell in a very tricky spot. But now the markets are almost fully pricing in that September cut, so it will be really, really hard for him to justify a hold. Now, here in Canada, the Bank of Canada, they've been holding rates at that 2.75% level. They've been citing sticky core inflation, interesting. And so Governor Tiff, he's facing his own local domestic dilemma here. Think about this. If Canada cuts rates before the US, right, then the loonie could weaken, and that would make imports more expensive, and potentially that would keep inflation high. But if they wait too long, then of course they risk slowing down growth while the US enjoys an easier monetary policy here. So when we look at what's really going on here, the headlines are both technically correct. If we think about hot inflation, yes, core inflation did jump the most in 6 months, cooler than expected. And yes, the markets did fear worse, but there are real risks that both the Fed and the Bank of Canada are facing here. If the Fed cuts too soon, then inflation could rebound. That is a real risk. Bank of Canada, if they cut before the Fed, then any sort of currency-driven inflation could also spike. Look at the current odds in the US of a cut by October. Today, 69.1% chance that there will be two cuts by then, down to 3.75%, 30.3% chance of one cut, and only a 0.6% chance of no cuts. So if the Fed does cut in September, the Bank of Canada holds, then we can expect the US dollar to strengthen against the CAD. That's bad news, of course, for Canadian import costs, but it's good news for US exporters. So question to you is, who is taking the bigger gamble here? The Fed? They could be leaning towards cuts even though we see that core inflation heating up, maybe counterintuitive, or is it the Bank of Canada that risks holding rates too tight in a softening economy? I hope this helped you understand this weird dynamic between inflation rates and interest rates. Drop your thoughts in the comments. As always, I say thank you for watching. We'll see you in the next video.